Hey there, and welcome. If you've ever felt like the world of investing is just this massive, uncharted ocean, trust me, you are not alone. It can feel really overwhelming. But today, we're going to give you a map. We're going to give you a compass. We're going to look at all the different ships you can use to navigate these waters.
And this quote, I love it. It just perfectly captures a fundamental truth, right? Trying to go it alone, just trying to swim in this vast ocean, it's pretty much impossible. You need the right tools, you need the right vessels to make any real progress. And that is exactly what investment vehicles are. They're your personal fleet.
And look, that feeling is totally understandable. There is a huge universe of options out there. You've got stocks, bonds, crypto, real estate. The list just goes on. And the sheer number of choices, well, it can be paralyzing. It causes a lot of people to just stop and do nothing at all. So our goal today is to cut right through that noise and give you a really clear place to start.
So before we start inspecting all the different ships in our fleet, let's just answer the most basic question of all. Why should we even set sail in the first place? What's the whole point of this?
When you strip everything else away, it's really that simple. Instead of your money just sitting around doing nothing, investing is the act of sending it out into the world to work for you. It's all about putting your resources to work today so they can create even bigger benefits for you down the road.
Now, the real engine, the thing that's going to propel your fleet forward, is something called compound interest. Just think of it like a powerful ocean current that gets stronger and stronger over time. See, with simple interest, you only earn on your initial investment. But with compounding, you start earning interest on your interest. It's this incredible snowball effect that over the long haul is probably the single most powerful force there is in building wealth.
Okay, so if we're going to build a fleet, we have to start with the two most essential, time-tested vessels. These are kind of like the battleships and the reliable cargo haulers of the investment world, stocks and bonds.
First up, we've got stocks. When you buy a stock, what you're really buying is a tiny little piece of ownership in a company. You become a shareholder. Now, you can make money in two main ways. Through dividends, that's a share of the company's profits, or through capital gains, which is just selling the stock for more than you paid. Stocks are like the speedboats of your fleet. They've got high potential for speed and growth, but yeah, they also come with more risk. And then we have bonds. Now, if a stock is owning, a bond is loaning. You're basically lending your money to an organization, like a government or a big corporation. In return for that loan, they promise to pay you regular interest and then at the very end, give you your original loan amount back. Bonds are the steady, stable cargo ships. They're generally safer and way more predictable, but you guessed it, they have lower potential returns.
So let's just make sure this sinks in, because this is the absolute crucial difference. With a stock, you own. You're a part owner, and you share in the company's ups and downs. With a bond, you loan. You're a lender, and you're just entitled to your agreed-upon payments. This one fundamental difference is what drives everything about their risk and their potential reward.
Now, owning individual stocks and bonds is a great start, but it brings up a major challenge, especially for new investors. And that brings us to our next category, managed fleets. Think of them like pre-packaged flotillas designed to solve this exact problem.
And here is that problem. To lower your risk, you have to diversify. You've heard the saying, don't put all your eggs in one basket. Well, how can a regular person possibly afford to buy shares in hundreds of different companies and bonds? It would take a ton of money and, frankly, a ton of time.
So one of the first big solutions is the mutual fund. A mutual fund basically pools money from thousands of investors, people just like you, and uses that giant pot of cash to buy a whole bunch of different stocks and bonds. The key thing to know here is that it's actively managed by a professional fund manager. It's their full-time job to pick the investments and try to get the best return for everyone in the fund.
The second huge solution is the exchange-traded fund, or ETF. An ETF is also a basket of investments, so you get that instant diversification. But it trades on the stock exchange, just like a single stock would, so its price goes up and down all day long. And what's really important is that most ETFs are passively managed. So instead of a manager trying to pick winners, they usually just track a market index, like the S&P 500.
This table really breaks down the key differences. So you see, mutual funds, typically active management. That means you're paying for a pro's expertise, which usually leads to higher fees. And they're only priced once at the end of the trading day. ETFs, on the other hand, usually passive. That leads to much, much lower fees. And you can buy and sell them all day long, just like you would with a share of Apple or Ford.
So, we've covered the core of the fleet. But believe me, the investment ocean is vast, and there are all sorts of other vessels out there. Let's just take a quick peek at some of the specialty ships you might run into on your journey.
Yeah, this includes stuff like real estate, a physical asset that can bring in rental income. You've got commodities, like gold or oil. There are those newer, much more volatile vessels, like cryptocurrencies. And then you get into some really complex instruments like options and derivatives, which, frankly, are for more advanced navigators.
But for a beginner, it is absolutely vital to put these in the right context. Think of these alternative investments as the spice, not the main course. Sure, they can add a little flavor and maybe some diversification to your portfolio, but the real substance, the real nutrition, that comes from your core fleet of stocks and bonds.
Okay, we've surveyed the shipyard. We know the different types of ships available to us. But a fleet is completely useless without a captain and a destination. So the final, and honestly, the most important piece of this whole puzzle is you.
And here's something you gotta know. You don't just buy these things in a vacuum. You hold them inside different kinds of accounts, like a 401k from your job or an IRA you open yourself. And each of these accounts has its own rules about taxes and how much you can put in. So the where you invest is just as important as the what.
Because ultimately, the right fleet for you depends entirely on your personal voyage. What are your goals? Are you saving for a house in 5 years or for retirement in 30? What's your time horizon? And maybe most importantly, how do you feel about risk? Answering these questions is how you calibrate your own internal compass, and that's what helps you choose the right vessels for your journey.
So, let's do a quick recap. What have we learned? Number 1, compound interest is that powerful current that's always working for you. 2, stocks and bonds are the reliable core of your fleet. 3, mutual funds and ETFs are these amazing pre-built flotillas that give you instant diversification. And finally, and most importantly, understanding yourself, your goals, your timeline, your stomach for risk, that is the key to charting your own course.
So, we've laid out the map for you, and we've introduced you to the fleet. The next step? Well, that's yours. This journey into investing, it's a personal one, and it all starts with deciding to take the helm. Thanks so much for joining me.